Element Fleet Management Corp, EFN on the TSX, currently trading at a price of about $28.50, $11.5 billion market cap, and about a 1.7% yield. So they're the world's largest automotive fleet manager with 1.5 million vehicles under management as of June 30th, 2024. And the company offers fleet services, including vehicle acquisition, maintenance, accident handling, remarketing, and EV integration to corporations, governments, and not-for-profits across North America, Australia, and New Zealand. And they have also been expanding operations in Europe and Asia. So the last time we covered Element on the podcast was by Aaron in December of 2023. Well, it traded at a price of about $22 per share. So over the past 9 months, the stock has performed decently well, up approximately 30%. But let's dig into why we have seen the positive share price performance and if we believe that can continue. Now, looking at the recent financials for Q2 of 2024, keep in mind all the financials I'm referencing here are in US dollars. And if you go back and compare this analysis to Aaron's video from December, note that all of the figures Aaron highlighted were in Canadian dollars, as the company has now switched its reporting currency to USD. And as Aaron mentioned last time, the company markets themselves as a fleet management company, which implies a service business. But there's also a lot of financing in the business as well, with 51% of revenue being from services, 45% from financing revenue, where essentially they are making loans and receiving interest payments on those loans. And then 4% of revenue is from syndication revenue, which from my understanding is leasing services. So actually looking at the numbers here, revenue increased in Q2 14% to $275 million, led by growth across all of its revenue lines, with service revenue up 11%, financing revenue up 16%, and syndication revenue up 42%. Net income, this is accounting net income, was up 15% to $103 million roughly, and adjusted EPS was up 16% to 29 cents per share, both being driven by margin expansion, as adjusted operating margin was about 55.7%, a 60 basis point increase year over year, which management indicates is from positive operating leverage, as net revenue growth has been outpacing growth in operating expenses. And the balance sheet has about 83 million in cash, with 8.7 billion in debt, and leases, providing a net debt position of about 8.6 billion. And the company has a trailing net debt to free cash flow multiple of about 8.5 times. Now, moving to the company's guidance, they recently raised it given the strong performance in the first half of fiscal year 2024, now up to revenue of 1.06 billion to 1.08 billion, which is an increase of about 11 to 13% over 2023. Adjusted EPS is now expected to be $1.07 to $1.11 per share, representing an increase of 9 to 13%. And adjusted free cash flow per share is now expected to be $1.32 to $1.36 per share, up 6 to 10% over 2023. However, I will note that the company isn't removing any non-recurring costs associated with its strategic initiatives, as well as the acquisition of Autofleet, which I'll briefly go over here, which may lead to a bit of a drag on accounting earnings as the acquisition is integrated. And using this guidance, the stock is trading at about 20 times forward adjusted EPS and about 16 times forward adjusted free cash flow, while it's anticipating growth of about 9 to 13% in adjusted EPS. So to put this into perspective, when Aaron covered the stock last, it was trading at about 17 times forward 2023 earnings, with expected growth of 14%. So relatively speaking, the company is a bit more pricey for less anticipated growth as compared to where it was at December 31st or December of 2023. And just a few operational updates here. As I noted, the company announced the acquisition of Autofleet on August 13th, 2024, which is expected to close in early Q4 of 2024. Now, I couldn't find much information on the acquisition details itself, such as a price paid or its financials. So we're kind of left in the dark there. And the company also provided a strategic initiative update, which included the plan to optimize the business by centralizing the US and Canadian leasing operations and establishing a strategic sourcing presence in Asia, which is expected to provide a run rate revenue of about 30 to 45 million by 2028. So, that's still quite a ways out. And furthermore, in August, the company also commenced operations in Dublin. And in April, they announced commencing operations in Singapore. As you can see, the strong financial results year over year in the first half of 2024 have led management to increase their guidance for fiscal year 2024 and has, of course, led the stock higher given this performance. Now, the yield of 1.7% is decent, and the company continues to increase its dividend up from an annual dividend payment of about 10 cents per share in 2016, now up to 48 cents per share in 2024, with a payout ratio of a roughly 30% gap or accounting earnings per share. Now, fundamentally, the valuation isn't unreasonable on a forward adjusted EPS and adjusted free cash flow basis, but it may be on the higher end given nearly half of the business comes from financing revenue. And as Aaron mentioned back in his last segment on Element, it is difficult to value the company given the high composition of financing activity that the business conducts, as the valuation appears more attractive if we value it as a fleet management services business. But as a financing business, we would anticipate the valuation to be much lower, given, again, like he referenced, banks are typically trading around 10 times earnings. And as a composition of total revenue, we're actually seeing net financing activity increase by a few hundred basis points as a portion of total revenue compared to when Aaron looked at it last. Now, I'll also note that the debt leverage remains relatively high for the business. And all in all, we don't think that it's a bad company. There continues to be momentum in its financials, but at this time, we continue to monitor. And just for the listeners out there, I'd like you to leave a comment. If you think we should be valuing it more as a pure fleet management services company, but generally seeing that financing revenue, it's tough to do so in our opinion.
Yeah, and one of the challenges, that I've had with Element is just exactly like what you've said, is that when you look at their materials, they always market themselves as a fleet management company, right?
Mm-hmm.
But they're really every bit as much a finance company, right? And as you
Yep.
said, finance companies typically trade for lower valuation unless the growth is extremely exceptional. But even then, it would be a lower valuation relative to companies that are in other industries, maybe like tech with the same growth. So the point just being, it's kind of a difficult company to value. I think 20 times earnings for a fleet management company, if you're looking at like long-term contracts, recurring revenue, is reasonable. But I at 20 times, it doesn't look certainly like it's undervalued to me. And then that's a pretty heavy debt to EBITDA ratio as well.
Yeah.
So high debt leverage.
Yeah.
Yeah, I would say there is some significant risk in the
Yeah.
company with the current valuations. It's not overtly expensive, but based on what a typical financial company would be valued at, it is in the higher end.